Welcome to the Valuation Desk by Highland Global. Thank you for joining us. In this session, we're unpacking business valuations for SBA 7A lending, a topic that's critical for making smart loan decisions and staying compliant with SBA rules. My goal is to make this clear, actionable, and useful, whether you're a lender, analyst, or business owner. By understanding how valuations work, you'll spot red flags, support better deals, and keep the SBA happy. Let's dive in. First, let's nail down a key distinction: fair market value versus strategic value. Fair market value, or FMV, is the price a business would fetch in an arm's-length deal between a willing financial buyer and seller, both informed and under no pressure. That's the standard for the SBA, and it's what lenders must focus on. Strategic value, on the other hand, is what one specific buyer might pay for unique benefits, like a chain buying a local competitor to kill competition. That premium doesn't fly with the SBA. They want objective, supportable valuations, not wishful thinking. Valuations for SBA 7A loans rely on three main approaches. Income approach looks at the business's future cash flow potential. Market approach compares the business to similar companies sold recently. Asset approach, used for asset-heavy or struggling companies like those with lots of equipment but no profits. The SOP requires using one or more of these accepted methods. For healthy, profitable businesses, the income approach usually takes the lead. Let's zoom in on the income approach, starting with the discounted cash flow method, or DCF. With DCF, you project free cash flows for several years, then discount them back to today's dollars using a rate that reflects the business's risk. You also add a terminal value for cash flows beyond the forecast. For stable businesses, there's a simpler option: the capitalized earnings method. Take a normalized earnings figure and divide it by a capitalization rate. Example: an HVAC company generates $500,000 in free cash flow. With a 20% capitalization rate, the value's $2.5 million. That's $500,000 divided by 20%. Free cash flow is the lifeblood of income-based valuations. There are two types of free cash flow. Free cash flow to the firm, cash available to all investors, debt and equity, used to calculate total firm value. Free cash flow to equity, cash left for shareholders after debt payments, used for equity value. Here's how you calculate free cash flow to the firm. Start with EBIT, earnings before interest and taxes. Subtract taxes, capital expenditures, and working capital changes, then add back depreciation. Example: a business has $1 million EBIT, pays 25% taxes, $250,000, spends $100,000 on equipment, adds $50,000 to working capital, and has $50,000 in depreciation. Free cash flow to the firm is $1 million minus $250,000 taxes minus $100,000 CapEx minus $50,000 change in working capital plus $50,000 depreciation equals $650,000. That's the cash available to service debt or pay owners. Total firm value, or enterprise value, includes debt and equity. Equity value is what's left for owners after subtracting debt. Here's how you calculate free cash flow to equity. Start with EBT, earnings before taxes. Subtract taxes, capital expenditures, working capital changes, and reductions in long-term debt, then add back depreciation. The market approach compares the business to others. Guideline public company method uses multiples from public companies in the same industry. Direct market data method pulls data from private business sales using databases like ValueSource Market Comps or BizComps. SBA expects appraisers to justify their comps and document adjustments clearly. The asset-based approach shines for asset-heavy businesses like manufacturing or construction. Book value method uses accounting values, often outdated. Adjusted net asset method updates assets and liabilities to fair market value. But this ignores goodwill or future earnings, so it's mainly for underperforming or asset-driven firms. Valuing private businesses is tough. Here's why. No public data. You're stuck with indirect comps and lots of adjustments. Personal expenses. Small businesses often mix in owner perks, requiring normalization to clean up earnings. Illiquidity. Private companies aren't easy to sell quickly, so a discount for lack of marketability may apply. Key person risk. If the owner's the linchpin, what happens if they leave? Unreliable projections. Small businesses rarely have solid forecasts. These must be tackled thoughtfully to meet SBA's standards. Let's talk real-world hurdles. Data quality. Small businesses often have messy or incomplete financials, making normalization tricky. Appraiser independence. SBA requires the lender to engage the appraiser, not the buyer or seller, which can delay processes. Regulatory scrutiny. SBA reviewers dig into valuations, flagging unsupported assumptions or missing documentation. Over-optimism. Buyers or sellers may push for inflated values, pressuring appraisers to stretch numbers. Here's how to navigate these. Demand clean data. Insist on at least 3 years of tax-verified financials to ensure accurate normalization. Verify independence. Confirm the appraiser is engaged by the lender and free of conflicts, per SOP 50-10-8. Scrutinize assumptions. Check that valuation assumptions, for example growth rates and discounts, are justified with data, not guesses. Document everything. Appraisers include clear comps, normalization details, and risk adjustments in reports to satisfy reviewers. Let's wrap up. SBA valuations must stick to fair market value, not strategic value. Use the income, market, or asset approach, grounded in recognized methods. Free cash flow drives income valuations, and understanding total firm value versus equity value is key. Valuing private businesses takes careful normalization, judgment, and documentation. The SBA needs a valuation from a qualified source that backs the loan amount. Thanks for joining us for this episode of the Valuation Desk. At Highland Global, we bring decades of hands-on experience to every appraisal we deliver. SBA lenders trust us because we understand what's at stake. Accurate, credible valuations that withstand scrutiny and support sound lending decisions. With thousands of reports under our belt, we don't just meet expectations, we help set the standard. Our deep knowledge of valuation principles makes us the go-to choice for lenders who demand expertise they can rely on. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.